Adding to a loser, your trading plan. So what is this phrase, adding to a loser? It's a very straightforward phrase that simply refers to adding additional stock or options or contracts or lots. Whatever you're trading, you're adding more of it to your existing position. The key is that you're adding this to an existing position that is currently losing money. So you are on the wrong end of this trade or this investment, and you are adding more. You are spending more of your money, investing more of your money to add to this existing position. Now, some traders do this out of panic, adding to a loser, but sometimes they simply do it to reduce their cost basis. This is known as averaging down for long positions or averaging up for short positions. They're trying to reduce the total amount of money they have per share or per contract or per lot. So when they invest money after it's already losing, well, this costs less. And so the average of all of the shares or all the lots that they've bought is lower than the original investment or the original trade. And some would argue that this is a viable strategy if you know what you're doing or you have a strategy that's zeroed in on this. But it also can be a tremendously costly mistake, especially for new investors or new traders. Because what it does, albeit reducing your cost basis, is it likely draws you away from your original trading plan and puts more of your capital at risk, which is fine, except when losses occur, when the losing trade or losing position doesn't work out, this can have a tremendous negative impact on your trading account. So when it does work out, you've reduced your cost basis. When it doesn't work out, your trading account can truly suffer. So why do traders stay in losing positions? Why does this occur in the first place? Well, there are two main culprits: pride and greed. Traders hate being wrong, absolutely hate it. And they also hate losing money. So much of trading is psychology. So much of trading is the desire to be right, the desire to make money, but it's also the desire not to be wrong and not to lose money. And so there's a lot of emotions in play when you're trading. Traders always need to ask themselves, and this is key, why did they enter the original trade? What was the logic? What was the criteria? This is going to vary from investment to investment, from trade to trade. But what was the criteria when you entered that trade, when you entered that investment? And ask yourself if it still exists. If you were trading off a chart and it broke through resistance, but then pulled back, and you entered because it broke resistance, is the reason still there? If you analyzed a company because of the fundamental criteria, are those fundamentals still there? If the answer is yes, well, you approach it one way. Perhaps you do add to a loser. Perhaps you do average down. In the case of a long-term investment, if the fundamentals are still there, if the reasoning was still there, but if the answer is no, if your original reasons for entering a trade or entering an investment are no longer there, then you need to ask yourself, why am I still in this trade? Is it simply because I can't bear the thought of losing? You need to develop an approach to trading that helps protect yourself from yourself. You need to come up with a plan, and you need to stick with your plan. It's far easier to be clear of mind when you enter a trade than in the midst of losing a trade. Money has a powerful effect on emotions. When you enter a trade and you're in the midst of making or losing money, this is very, very impactful on your emotional state. This is why numerous experienced traders, investors, teachers, mentors, they advocate creating a trading plan. And while you're trading, while you're investing, stick with your plan. You can always go back and rework your plan, but never in the midst of an emotional state. In the midst of a trade, you stick with your plan. And if the market goes against you, so be it. Nobody is perfect. Nobody has ever batted 1,000. You will occasionally lose money. Those investors and traders that live to fight another day often take a prudent course, and they're willing to let go when they're wrong.